All right, folks, welcome to the Property Couch podcast. And have we got an exciting episode for you today? We are going to cover our property market outlook for 2023. And if you stick around to the end, Ben, we're going to cover all the risks and all the opportunities. But what else are we going to cover?
Well, Bryce, you can't do that unless you have a thesis. What is your logical thinking to get you to the decision that you can make about the property outlook? So we are going to unpack. There's that word, unpack. It's coming back, Bryce. It's coming back. Unpack that thesis in today's show.
So, folks, let's go and unpack it now. Let's rip into the show.
Welcome to the Property Couch, where each week you get to listen to two of Australia's leading experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle Channel, co-host of Escape from the City on the ABC, and partner of Empower Wealth Advisory. Ben Kingsley, chair of Property Investors Council of Australia and the founder of Empower Wealth Advisory, named the 2018 and 2019 Property Advisory Firm of the Year. Stay tuned as they bring you the insider's guide to property, finance and money management.
All right, folks, welcome back to the Property Couch podcast. Welcome back to you too, mate.
Thanks, mate. Yes, I know. I'm looking forward to today's discussion.
Yeah, me too.
It's a big conversation today.
It is a big conversation. So we've kind of set it up with some really great stories over summer. And then last week we helped people get their house in order to see what their WealthSPEED was, which, by the way, got some really great feedback personally about that episode for people to go on there and see what that looks like. So already people are super keen, Ben, to see what their speedo looks like, i.e. the WealthSPEED. And hopefully gives people a really good excuse to go in there and update those numbers so they can actually see what that looks like. And of course, having it mobile makes it super well. So that was a good episode last week, Ben. So the feedback's been great. And then this week, you earlier in the week, you did your RBA update as a result of the cash rate being increased by 0.25. So for anyone who is out of cycle, used to listening to us just on the Thursday, Ben, you can go back and see that earlier episode, which is always good feedback from you about the insights that you see. But then today we're going to talk about the property market outlook for the year ahead, which we've been preparing for a little while, and we're looking forward to it.
Yeah, it should be a lot of fun. I mean, obviously, some of it's not fun. A lot of people have a lot of anxiety around this stuff. So I probably shouldn't use that word. I mean, we're going to be quite measured in terms of how we're talking around the data that we're seeing and the data that's coming in, and building off the back of the economic update from Tuesday. We should be able to then flow that into, the thesis around and a hypothesis around what we think is going to happen in the property market with interest rates where they are and where they might be going.
Yeah, and you and I saw Bernard Salt. I wish I could remember the year, but it felt like it was back in 2019, maybe 2018. And he made this statement: wherever there's noise, go to the facts. And it's just always resonated with me, because for some people listening to this, they would have been bombarded over the last 48 hours, Ben, with stories about what an interest rate rise means and sort of mainstream media's interpretation of what that looks like and how to get people's attention with the equivalent of clickbait on the nightly news. But we're going to present a thesis today on our feedback on how we see it for the short term and for the remainder of the year. And we're going to give you some methodology, Ben, on how we arrived at our conclusion. So hopefully that gives people some encouragement on how they can interpret everything that's going on right now, as that relates to their household, as it relates to their ambitions going forward, and as it relates to their property portfolio. Before we get to that, just want to let everyone know that the team of Stigs around here, Ben, made it super easy. So whenever we talk about getting the free book, whenever we talk about downloading the More app, whenever we talk about going and watching the masterclass that you and I presented, anything that we talk about within the episode, Ben, all you have to do is tap in the description of, if you're on iTunes, in the description, if you're on Spotify, if you're on Android, just tap the description and all the links are there. We will have that each and every week from this point going forward to make sure, how do I actually get that again? Super simple. Just tap on the description and it will all be there. And for those people who actually subscribed to our regular newsletter, Ben, that we send out once a week, if you haven't, you can go to thepropertycouch.com.au, log in there, gives you details. All we need is your email address. We'll send it out to you. We always put the links there as well. But for those people out there, just tap on that description and you will be able to check that out. So let's rip into the show, Ben. Today's Mindset Minute. Andrew and I, as you know, Ben, we spent a bit of time over summer having a bucket list summer with the boys. And we had a lot of conversations about them and their responsibilities in the household. And she and I are not there just to serve them, and some of the boundaries that we want to do around pocket money and the things that we need to do. And there's probably people listening to this who are super awesome at it. And I would say I'd probably give myself a B+ sort of in that area. Can do, there's lots of improvement. And we had some conversations with them, and they went super well. But my wife used this comment with me, and I thought it was really, really good. She goes, if you raise your children, you'll get to spoil your grandkids. But if you spoil your children, you'll be raising your grandkids. and it really resonated with me, because I do know someone who has had to, in the second time around, raise their grandkids within our own community. And it's interesting to see some of the conversations and the patterns around. They don't know that I'm asking leading questions, but I'm trying to get a better understanding of why. And so I don't mean to flick anyone's switches, Ben, because we're all having a swing. There is no instruction manual. You and I talk all the time about,
I'm shocking at it.
Some of the things that we grew up with that don't actually work in this generation, all that sorts of stuff. But I just think some basic fundamentals around the boundaries with your kids. But that resonated with me. I wonder if it resonates with anyone who's listening. If you raise your children, you get to spoil your grandkids. But if you spoil your children, you'll be raising your grandkids, and which is something for us to ponder as we go in. All right, let's rip in, Ben. Property market outlook for 2023. We are going to talk to how we've interpreted the data, what we see going forward. And we've got this position of being, I think, reasonably well positioned, Ben, because we have this platform that we get to speak into people's lives.
Yep.
But we also have a business that allows us to get coalface data and sentiment and activity and all sorts of, I guess, so it's not just theory for us. We get to interpret the theory and speak to some of the best minds in the country, but then we get to munge that up and see how it's actually playing out on the ground at an auction, at a exchange of contracts, at an offer and acceptance. We get to see that. So hopefully for our community, what we want to try and provide is a guidance to interpret some of the noise, provide you with the facts, and hopefully give you some something to go away with as we sort of lead into 2023. So where do you want to kick us off, Ben?
Well, I think if I can just add to that story, I mean, yes, that live feedback in the field, you've got to remember that we're buying, we have buyers agents effectively all over the country, and we're buying, significant amounts of property every month. And so we do get that instant feedback in terms of what's happening on the ground, and we're seeing the opportunities out there. And I suppose, the conclusion at the end of last year was, the quality of stock was variable, meaning not really good. The other bit of feedback that we had on the ground was any finished product that was well located was still selling very, very well. Mm-hmm. People were very apprehensive of the cost to rebuild and renovations and the challenges with getting tradies and that all. So people wanted complete instant fixes, quick gratification purchases, and they would pay a premium for those. So they were also challenged. So they were the themes that came off the end of last year, and now obviously we're 2 weeks into the start of the auction season in the major capital cities, and I've been asking people around the country and our buyers agent in terms of what the feeling has been out there, and this is pretty normal for the first couple of weeks of a new auction season, and that is we normally see a spike in sort of clearance rates, and we've seen a bit of that. So we're not going to say that that's basically rightio, we're calling it now the market's turn, but we are certainly seeing more activity on the ground. And I suspect that would happen, like you get a 5 or 6 week hiatus, you get a bit of pent up demand. So it really is the depth of that demand that you want to be testing in the market. So I'll leave that thought because we're going to come back to that. But I wanted to take the liberty, Bryce, of setting up today's conversation. And you'll find that, again, we're going to be reasonably measured around how we put this together. But our hypothesis around what's going to be happening in terms of property prices, we have what's referred to as a baseline scenario. And so if these are to be true, then this is how we see the marketplace playing out, and that really is going to be the sort of the anchoring of our thoughts around what's going to be happening in terms of the market. So,
and we're going to flesh out why we think that's our baseline case as well, so people can actually pressure test us, right, to see if we're objective or not. So, well, no, I was just going to say, because quite often people sort of say, you guys are in property, you're always talking up property. So we feel the responsibility of providing enough rigor around what we have to say when we've got this platform, so that people can actually go, all right, fair enough, we've listened to what these guys have said for a period of time, some people 5 minutes, some people over the journey, but as much rigor, and our attempt today is to provide as much rigor as we possibly can around that baseline case, so people can walk away from this and have some independent thought to say, do we agree or do we disagree with these two?
Yeah, thank you, Bryce, for setting that up nicely. In terms of the theory that we have to work through, or the thesis that we're working through, is in macroeconomic sense, what is holding the property market back? So in any of these types of decisions that you make when you're an investment advisor, you're trying to assess the market, ask the right types of questions, and then find the supporting data that are relevant to those particular questions. So the very first simple question is, what is holding the property market back right now? Well, the answer to that is interest rates. That is really, really clear. And then when you think about interest rates, what's determining interest rates, right? Well, that's inflation, all right? And inflation's too high, and that's why we're getting higher interest rates. So this is a good segue to come into our data and to start talking about, our baseline thesis. So our baseline thesis is that the cash rate stays between sort of 3.335 and 3.6. So we obviously got that 0.25 that I reported on Tuesday. Based on the commentary that we saw in the statement from the board, is that they're sort of predicting further increases. Now, I want to spend a moment on talking about that in regards to, back in the day when COVID was just hitting and we were told that interest rates weren't going to move until 2024, and we're going to have these record low interest rates and that type of thing. That is obviously part of doing this type of work is signaling to the market you want a certain type of outcome. You want confidence to remain high. You want investment to be there, and you're trying to give people some line of sight so they actually take action. In this particular case, what we're seeing here in the statement is, each decision does remain live, and Governor Lowe will be talking about that as he's interviewed over the next couple of weeks. But he's sending a really clear signal that he wants people to stop spending, and he wants the economy to slow quicker. And so by saying that they anticipate further increases is a really strong signal to the market until the data gets even stronger than the early indications in the data are, which is what we're going to explore now, is basically telling him that we're over that hump. And so for me, our baseline scenario, recapping, 3.35 to 3.6, and then a pause. Okay, so we're expecting then a pause, and that will be an important moment. We see in the statement that is also still referring to a soft landing, but that base case is narrowing, meaning that basically it's going to be very, very hard to thread the needle if he keeps introducing or increasing the cash rate higher and higher. That is effectively going to slow the economy down more significantly. We're also
soft landing, Ben, for the purpose of what people listening, is the idea is to have the labour market remain healthy. We avoid recession, and that inflation returning to that target range, which is 2 to 3%, over the journey without putting significant brakes on the economy. That's what a soft landing is attempting to do versus, and when you and I were preparing for this, we were talking about the plane analogy, whereas if the plane is airborne, taking off without sort of stopping and land, the plane uses most fuel on the way up. So if they can avoid that, that's what we're wanting to do. But to your point, what you said before, the more cash rates that they need to do, the harder that is going to be to achieve. Therefore, to use the term you just used, they're signalling. People need to take it seriously that if there is no reduction in spending, that is unlikely to remain a pause event. It will continue to be interest rate rises until they achieve that.
Yeah, there are a couple of critical things that are worrying the RBA, wage price spiral being one of them. And so that is, if we think about those negative things, it's energy prices, wage price spiral, and ultimately, that strong employment rate remaining too strong, which then sort of puts pressure on, that wage price spiral. They are the negative things, but we're going to focus on all of the news that we're seeing in the data that suggests that we're very, very close to this pause. And the first one is obviously the retail, trade. So we saw in the last quarter of last year, retail spending dropped 3.9%. We've since seen the volume data also come through, saying that over that quarterly period, that 0.9 growth over the quarter, 3.9% was December over that quarterly period. We saw only a 0.9. Now we've got the latest math on volume, and that's basically saying it was actually a negative quarter now, because when you think about a retail spending, you naturally get inflations on top of that. So it's the gross amount of trade turnover that's occurring. And so it's not true growth. It's just basically there's more population in the country. We'll talk about immigration soon. And that's basically what's basically been happening. So we've definitely got a slowing of consumer spending. Now, what the RBA is going to be looking for in the next couple of months is a significant, sort of turnaround. And they're hoping that really the December quarter was the last hurrah when it comes to the big amount of spending, and people bought airfares and they bought accommodation at silly prices. And so that really showed up in the core inflation point. And so that's
I noticed that too, Ben, in conversations I'm having with peer groups around here too, in terms of anecdotally, because down here in Torquay, I get within the the school group, there's a whole range of conversations that I'm having from people that are employed by others, that people are running their own business. So I feel like it's a reasonable cross section of society. And to most of the conversations I had over the summer, there was in January, which I didn't see sort of in November and December, was definitely a flavour of belt tightening. Some of them were saying, hey, listen, we're changing where we're buying our food from the supermarkets to Aldi. Other ones were saying, listen, we're going to liquidate some of our lifestyle assets to try and reduce debt. And so I noticed it quite sharply that from nothing leading up to Christmas to definitely in January, a big change in the narrative. I think that's an important thing with a lot of the information that the RBA are dealing with is lag data, right? So some of that stuff needs to show up, and it won't show up until through this month for them to make a decision when they have the same situation when the board meets next month.
Yeah, so you can almost put them into three buckets. So there is a population bucket that really is doing it tough, and these numbers are really tough for them. There's the sort of middle class, bigger bandwidth, which is the biggest bucket of all. And they're now, tapping into their savings area. And then there's obviously the final bucket, which is really, the largest group of high net worths. It's a small bucket, but, these types of changes really don't affect them. Their net worth is so significant. But it's really that middle tier bucket that it is going to be affected now. And what we've seen in the Australian savings ratio, household savings ratio, is it's collapsed. So during the pandemic, it went 23.7% in terms of savings ratio when we're all locked in and we're getting our money, our wages, but not being able to spend it on anything other than takeaway. And now it's back down to 6.9%. And so that's below the sort of long-term averages we're seeing of around 7 to 8%. So it's really clear that we've had our last hurrah when it comes to the mainstream of households in regards to that. So
as a podcast too, Ben, as an audio, it's very difficult to see that graph, but you can see it's almost like a 10-year journey. It just looks kind of steadily volatile, well, not volatile, but just up and down across. Then all of a sudden, when COVID kicked off, there's this giant M on the graph, and then it's come back to 6.9. So it just kind of shows that interesting human psychology here I see too, is because your bucket size is usually only so full. So when I earn enough income, I have expenses to match. But as soon as my income goes up, so it's not as if our savings stay large for long. It's just, well, when it's a first opportunity, let's spend it as quick as we can, and we've been doing that.
Yeah, we really have. And it's a testament. Look, that's proven in any society, but if you give people money, they spend it, right? We all can't be trusted with our own money. Hey, the other two big ones that I just want to round out with is Barrenjoey's chief economist was talking about 50% of the current cash rate adjustments that have been made before Tuesday's decision haven't actually flowed through to households yet. So that should also be a shock to the family budget. So that is going to have forced spending and force contractory, in terms of consumer and discretionary spending. And finally, we've got 2/3 of fixed home loans, reportedly between $200 to $300 billion worth of fixed home loan rates are coming out of fixed periods this year. The bulk of it being in the second half of the year, but there's still a good portion of it in the first half of this year. And we're talking about, an extra $1,000 on average in terms of those mortgage repayments per month. So that is a significant hit to the family budget. So we do expect over the course of the next couple of months, looking at the data, that there's going to be a severe correction when it comes to consumer spending. And that will be, unfortunately, music to the ears of the RBA in the short term, because it means that, they won't have to continue to keep risking crashing the economy to try and get inflation under control. Like they're really clear that inflation is too high. They need to do everything they possibly can, but they don't want to crash the economy. Well, that is going to be helping them in terms of not crashing the economy.
Yeah.
Moving along now, let's look at the inflation indicators. So just a summary of these inflation indicators. It's really important to note that, again, this is lag data. We have moved to monthly reads, but we're still working out how those monthly reads are playing through in the data. So it's really the quarterly data that has the most focus by the economists and so forth. And so we saw headline inflation in the December quarter. We saw it rise by 1.87. So headline inflation was a reading at 7.83. And we saw the trimmed mean, or the core inflation, which strips out energy costs and food costs, those more volatility costs, that increased in the December quarter by 1.66. Now, that was higher than the RBA wanted, and that was really the catalyst for their narrative around further increases and that signalling to the market. Now, what's interesting to understand here is in the September quarter, we only had 1.87. So that was the peak of the core inflation. It's actually come off that peak in December, but it's still too high. And then the same with the headline inflation at 7.83. That's the highest. That's now behind us. If we actually look at what's happening around the world, US sort of leading the way, their inflation story is about sort of maybe 4 to 6 months ahead of us. But we do expect inflation has peaked. In fact, Jim Chalmers in Parliament on Tuesday afternoon also, made a comment inside Parliament House, basically saying that we expect, the worst of inflation is now behind us. And so, that is a good sign, but we still need to have more confidence in the data for the RBA to basically pull the trigger on that. We did see one of the catalysts for that really, sharp spike in core inflation was recreation and culture. I spent enough time talking about that in my update, but in summary, it's really simple that with all this pent-up demand and with all this spare cash, we just went for gold at Christmas time, and we spent whatever the airfare was. We were paying
airfares were making record profits.
Whatever the accommodation prices, we were paying for it.
Yeah.
And so we expected that to finish. And again, Qantas have come out, Virgin have come out. They've all said that prices are expected to fall. Competition and aircrafts are expected to increase their frequencies and so forth. So that'll bring airfares down. And we also expect that with businesses stopping their spending and leisure spending slowing down, accommodation houses will have to drop their prices as well to attract those people. So we're seeing it in the leisure and discretionary spending. The big one for me was the business story that came out. So the NAB Business Sentiment Survey data. So forward orders, capacity utilization, capital expenditure intentions, all in decline. Business credit in decline. And the good news from a inflation point of view, growth in final prices and inputs such as labour, purchase costs were all weaker in January. So that is telling us that all of the input costs and those costs are definitely falling. And so now we're sort of relying on businesses to sort of say, if consumers stop turning up, that will mean businesses will be able to go on sale or reduce their prices, and that will start showing up as disinflation. which will be the buzzword for that as well.
Super important too, because businesses would like, well, we could just put our prices up and people pay it.
Yeah.
And we put our prices up and people pay it. So you could see that there was no incentive for them to deviate from that path. But that, as you say, the data suggesting that is in decline is good news, because then you've got final prices being lower as a response to labour costs and your input costs, or your purchase costs being lower as well. Which, you to your point about September being peak inflation, if you're having these conversations back then, that's when the businesses were just going, we'll just put the price out there because people are paying it. And airlines being one of the big ones doing that.
Yeah, so core inflation will be coming off, and supply side inflation is definitely past us. So we're seeing that in shipping costs, freight costs, transport costs, all of those things, those bottlenecks have all eased, and so prices will come down there. So the good news from the current inflation story is, and our hypothesis is, that's it. We've peaked and it's now downhill, but it's just about how quickly we return back to their target range of 2 to 3%.
Been interesting too that the Treasurer's been out lately talking about how their May budget will be very, very acutely focused on making sure that there's no stimulatory handouts that only exacerbate the inflation problem too. So you've got all of what you've just spoken about as well, but then you've got a government that's looking at fiscal policy that will support monetary policy, so that you don't sort of create another problem. That means that we're all over again having to do this again. So it's nice to see that narrative is actually supporting what you're seeing in all of the other indicators that are tempering inflation as well.
And then the final one, Bryce, you mentioned it earlier about the labour costs. So we saw that in the business data. Well, let's talk about the employment story and just focus in on a couple of those key points there. We had an amazing year for job creation across the country, but it was a story of two halves. And so what we're definitely seeing is, in the second half of last year, we had 125,000 jobs created compared to the first half of the year where we had 326. So job creation is definitely softening. We're seeing with the latest increases of net migration and all of those visas and all the bottlenecks, people are arriving in droves. That is awesome. So we're going to have more workers fit to do the work, and we've got advertised jobs and job vacancies actually falling. So lots of businesses now are putting on wage freezes. And so we're starting to again see those types of signs. So, that is really positive data to sort of say it's very hard to keep the unemployment rate at this level. And it's very hard to keep full employment when you've got an extra 100,000 people, 200,000 people arriving ready to do the work, but you've got industry outside of property definitely slowing down, and you've got businesses slowing investment. And obviously when they slow investment, they're slowing their employment intake. So there'll be some attrition in there. And we're seeing it in the RBA's statement around the unemployment rate. So they were sort of talking about in their statement that they expect the unemployment rate to go higher over the course of the next 12 months. And so that is also going to add or add to the story of a softening economy, which adds to the story of softening inflation as well. So I think they're the big ones that we wanted to just cover off in terms of what we're seeing more broadly. And we summarize that as, if inflation is starting to ease, then what's next for the property market? And then that is a big story here. So when we summarize property from an inflationary point of view, we've got a good news story that property makes up around 25% of the basket of goods. So on one side, actually falling property values is good for inflation. But on the other side, we've got tightening rents. And those tightening rents obviously add to the pressure on putting inflation higher. So it's almost like they're trying to counterbalance themselves out there. But the other really big news, remembering, again, property is around 25% of the basket of goods that make up the consumer price index. We saw construction costs are declining. So quarter three, 4.7% increase in prices. Quarter four, basically 1.9% increase in prices. And we expect this year, in the report that CoreLogic released, Cordell report, that actually prices will start to disinflate. So disinflation will occur in those property, and so there'll be no further increases in those particular areas.
Because you've got migrants coming in that can help with the workforce. You've obviously got the supply side issues with materials coming down, and the people are still building houses that have been booked before, but the amount of housing approvals, which we'll get into shortly, is actually declining as well. So that all bodes well for construction costs.
Yeah, so 41% decline in dwelling approval since March of 2001. So we've got that flowing
2021.
through. Sorry, 2021. So we've got that flowing through. But what we've also got here is as a story that a lot of people who have agreed to do house and land packages are actually forfeiting on contracts or delaying contracts as well. So the housing association is saying we're going to have a crisis at the second half of this year. We're just not going to have enough work for all of the tradies to actually do. So, or again, this whole idea of demand supply, there won't be as much work out there, which means that the tradies, the subbies, everyone will be reducing their prices. And that again bodes well for a better inflationary story. We're seeing it in the lending data. So we're seeing new home lending down 29.3%, owner-occupied lending down 29.8%, and investment lending down 4.4% in the last quarter. So that again talks to this story of a tightening housing market, and they are all positive stories for inflation. And that rounds out really the broader conversation that we wanted to have around property. And now we're going to double click on that property story, but come back to the framework that we were trying to talk to. So here's the macroeconomic story. What's holding property prices back? It's in interest rates. Interest rates are causing sentiment, which is holding people back. If inflation starts coming down, then there'll be an interest rate change in terms of there'll be a pause, and then effectively we'll start to see interest rates coming off. So what I wanted to talk to now was this story around what happens if there is a pause, Bryce, in terms of what do we see happening in the marketplace?
Yeah, well, it will release some pent up demand that's existing, because obviously some people that are keeping their powder dry. But you will start to see auction clearance rates start to trend up, and what not too dissimilar to what we experienced during the breakout for COVID is you'll have a scenario where that pent up demand will be trying to play itself out in a market that has very limited supply. There is we'll go through some numbers shortly, but the amount of supply is below 5-year averages, and in a lot of cases well down on the same time last year. So what's really interesting is as I said, we saw it play out in COVID, where people said, okay, everything's fine, let's get back in the car and go. One of the things that I observe the most, Ben, is people go, oh, well, I'll just change my mind, I'm ready to buy now, and then they think I can just go to the market and buy that Saturday. I tell you, we've got a team of buyers agents who'd love it to be that easy, but there's a lot of jockeying that goes on to find the stock, to position yourself for the stock, be in a position that you can buy the stock, and if you miss it, the market can potentially move whilst you're still on the sideline. So that pent-up demand is something that anyone who is a long-term player of property should be super acutely in tune with, because if we do go on a pause, Ben, well then obviously that will change what's going on in the property marketplace significantly.
100%, Bryce. And let's take a look at some of the data, right? Like let's firstly tell a story about what's the depth like in the market for demand. And so our early indications are that at the end of last year, clearance rates are at 55.1% for the last 4 weeks ending December 18th. And in 2021, that was a 65%. So 2021, 65%. Last year, 55.1%. Last week, that was the final result for the first auction week of the year, which is the first week in Feb, first Saturday in Feb. That clearance rate finished at 68.1%. Now, that's the best clearance rate since May of last year, to give some context. So as rates were starting to rise and demand had pitted out, basically everyone had exhausted that demand level. And so that sort of tells you a bit of a story. Now, remember, one swallow does not make a summer or a spring, as some people say. So we want to go into the data and start to think about just looking at the capital cities. And what we're trying to do in terms of talking to this story is we're trying to show you where demand is versus where supply is trying to take it. So this tells a really good story. And I know it's an audio podcast, so bear with us. We're going through a series of numbers here, but it does tell an interesting story in terms of where we're at. So I'll do the first couple, Bryce, and then I'll let you take it home. In terms of Sydney, in the last 12 months, so this is a 12-month rolling change, new listings in the Greater Sydney market are down 21.1%. And total listings overall are down 5.2%. Now, what is that telling you? That's basically telling you that even with listings being down, total listings are also in negative territory. So, you know, from a behavioral economist point of view, sunk cost bias is coming in here. I don't want to lose money. There's no reason for me to sell at the moment. I'm going to hold on. But it's also saying that if that story had been around the other way, where total listings over the 12-month had actually been positive, then you've got a greater risk of further correction in value. So by having a softer amount of supply, it's actually lessened the level of correction that we may have experienced in property values to date. And so that's Sydney. I'll do Melbourne and then I'll pass over the baton, Bryce. Melbourne, 21.5% negative new listings in the last 12 months, and total listings in Melbourne, negative 3.8%. So again, they're the types of stories you want to be looking at. So you want to be sort of saying, is supply increasing? The answer to that is no. Demand is meeting the amount of supply that's being put into those two markets. But the quality of the assets, the variability of the assets, that's the reporting we're getting in the field, is there's a lot of, you know, B grade and C grade properties that are being sold, and then the odd A grade property, but that's not enough to basically hold values at where they were from when you measure medians. So that's a couple of good examples of markets that are holding firm.
Adelaide and Perth have a similar story where both are in the negative. So Adelaide, the listings in the last 4 weeks down as a 12-month change is 8.5% down, and overall listings is 10% down. So that's overall stock is less. Perth is the same, 16.8 in the last 4 weeks for the 12-month change and 18.9% for total listings. Brisbane's slightly different. It's down over the last the new listings category by 21% with a 12-month change, but up slightly 1.5% for total listings, which reflects a little bit of what's going on in the Brisbane market now, where they're giving some of their gains back. But what's a real standout on this graph here, Ben, and again, audio, so we're trying to interpret it, but in Hobart, yeah. Hobart's a big story, because not only are new listings up for a four-week period for the same time 12 months ago, but overall listings in that marketplace, total listings 12-month change, so this time last year to now, is 85.8, so call it 86%. So that really speaks a lot to what's been happening in that market, because there's people been enjoying some good gains over the COVID run, Ben, and a lot of investment money is going in there. But when you've got a supply chain that looks like that doesn't necessarily bode well for price strength in that market at all.
It certainly doesn't. It's basically telling us that with 17% increase of new listings and then an 86% increase in total listings, it is a small market, right? So let's not lose sight of that. We don't want to, you know, scare too many people off who've got assets in that area. But it just says to us that there's not a lot of demand that's underpinning that story. That can change, like with, you know, you never know, there might be people waiting in the wings, but right now there's a lot more stock coming onto that market. And so that is probably the most oversupplied capital city market in the country. Darwin's got a good story around 22% less in new listings and pretty much flat for total listings. Canberra's got another story there where total listings are up 22%, almost 23%. So there's only two markets in Australia where listings are up, total listings are up on a 12-month change. All the other markets are basically holding firm. So those two markets, Canberra and Hobart, will be ones to watch in terms of further deterioration when it comes to price value. If they can't find a base level of demand, those people will eventually, so you want to be looking at things like days on market, because the stock on market, you know, that ratio is going to be quite elevated. So it's that, if that days on market is blowing out, then basically you're going to see property prices continue to fall there.
So supply is really a product of two things: how much new stuff's coming on, how much existing stuff's coming on. So the new stuff we already talked about diminishing, and existing stuff we're talking about in most capitals, with the exception of Hobart, they're diminishing. So on the supply side, there's not a lot coming on, right? So so demand drivers then become, okay, population to population, a product of population growth. Well, we know that's coming. Household size, well, that's just organic anyway. So the last one's the ability to buy, which is actually being affected by a whole bunch of stuff. So that is actually just a handbrake right now, which is affecting property prices, which is we started here. It starts with interest rates, which is being affected by inflation. So interesting to, again, our base thesis, whenever there's noise, go to the facts. Well, supply side's looking skinny.
Yeah, we'll sort of round that out. So we're seeing even, it's super tight on the supply side. We've seen the latest lot of listings around auctions. They're 26% down on this time last year. So we've started this year basically with a quarter less auctions than we were auctioning last year. Overall, when we summarize all of the capitals, combined capitals, we're down 18.2% over the course of the last 12-month change, and total listings overall are down negative 5.3%. Now, the other part to this story is new listings, Bryce, are 20% lower. So 20% lower than the average 5-year number of listings. So it won't take much in terms of a spike in demand with the amount of listings. So we will expect behavior to change as demand starts to arrive. We will start to see more stock coming on board. So we're not expecting that this idea of supply will stay super low forever. But if there's no forced sellers, then ultimately what we're going to see is the market flatten out, and it's going to be, what are the critical things that will help demand go forward? Well, that is, number one is the pause. And the other one that we've spoken about a bit is also the lending story in terms of people's ability to be able to get finance. And we are starting to finally see some murmurs with regards to APRA and the Council of Financial Regulators around this 3% buffer rate. It is totally absurd that they have servicing ratios at the level that they currently have them at. They need to completely rethink the way in which they're assessing longer term debt. They're even looking embarrassed now. I mean, the servicing assessment rates weren't even this bad when the global financial crisis was on. Yeah. So it just goes to show you, they could be the catalyst for a further correction that was unnecessary, and yet they're all about trying to put financial stability in the markets. Well, again, they could be the instigators of that. So can I just recap, Bryce, if I can? So again, what's holding the property market back? It's interest rates, clear and simple. What's impacting interest rates is inflation. Well, we've told you a story about what's happening with inflation, and we've passed the peak. So we've passed the peak now. So all we need now is, something to release the pressure valve of the pent-up demand that's there. How much demand is there? We don't know. But there is some demand. We know factually in our business and in talking to the industry, there's a lot of people sitting on their hands. So a pause in interest rates, we are 1 month closer to that. So it'll either happen in our thesis, it'll either happen next month or it'll happen the month after that. So if you're starting to line those things up, and if you're starting to think like an experienced investor, you're starting to think, well, if everyone else is waiting, and we're closer to that finish line of when some of that pent-up demand will be released, you've got to start thinking about when you're going to be timing the market, when you're going to be thinking about getting into the market over that time.
Yeah, lead time. I touched on it before. I'll touch on it again, Ben. If you decide this weekend that you want to all of a sudden buy, guess what? You're not necessarily buying this weekend. Yeah. And if you are buying this weekend, you are paying a fair bit to get the asset that you want, because the stock is skinny for A-grade assets. So thinking about that in terms of, okay, what does that lead time look like and how much time do I need to get in? Because it turns quickly, right? So, because a lot of people are always wanting to try and time the bottom, and that's fair enough because nobody wants to lose any perceived or real value. But doing that is really difficult, because on the way down, if we go back to the plane analogy, Ben, when you're trying to land, it's actually, that last approach is a little bit slower. But then if it was told the winds are not right, and you have to, and the pilot, it takes off quicker than when it was coming into land. And I think that analogy is something that people need to think about for property, because getting in on this side of the bottom will serve you better than trying to get on the other side of the bottom, because A, you can't pick it, B, momentum happens pretty quickly, and you can actually lose percentage value very quickly in a matter of a couple of weekends when stuff picks up, because we've only seen it in recent memory when that happened with COVID, to make that timing of the bottom very, very difficult to do. No one does it, and you're better off doing it this side of the bottom than the other side.
And it comes back to, the messaging that we're trying to interpret from the RBA here as well. I mean, at the end of the day, this is our thesis in terms of what we think is going to happen. But we're coming back to this soft landing exercise. And, part of the critical thinking that you want to be doing is you're sort of saying, well, if they keep increasing the cash rate, it's going to have a very material hard landing that you were just talking about. Whereas what's stopping the board and the RBA from sort of saying, hey, we've been pretty aggressive. This has been the most severe or sharpened cash rate cycle in correction that we've seen in modern history. And so if that is the case, why not wait for a pause? Because just because you pause doesn't ultimately mean that you need to stop increasing rates. But let's see what that's done to the economy first, because the more you keep raising rates without seeing what the impact is, the bigger the risk you have of crashing the plane, or having a hard landing, and then it obviously takes a lot more to take off. So that's the stuff that is what you get paid to assess in terms of when you're an advisor in the investment sort of space, in the investment houses. You're trying to make those determinations, but it's really clear that inflation peak is behind us. That is clear. That is now going to start showing up in the data over the next couple of months, and the trend will be your friend. So that is trending down. There's absolutely no doubt about that, unless some material black swan event happens or whatever. We lose energy or something along those lines, and so that we have a crisis.
Oh, you could have a natural something happens that affects in North Queensland, it affects flooding, the price of the food that we have. So there's definitely stuff.
There's definitely risk, but in terms of our base case scenario, that's potentially what we're looking at. And so we think that this is the most probable cause of action that's going to occur. And then we're starting to think about, okay, the timing. And you were saying there before, Bryce, about the lag effect associated with that in terms of getting in front of it. So I tend to look at it like this, and I'm not saying you as an active investor need to think about this, but I look at it like this. There's only one way in which I can guarantee of getting the bottom, and that is if I get in before the bottom. So for me, the bottom, if I lose 1 or 2 or 3% before I get into the bottom, and let's look at how the market's been rolling out, the corrections have been slowing down every month for the last 7 months. Right, so the pace of value deterioration has been slowing. So if I make a professional call, because what I don't want to be is competing against everyone else in the market, right? So I want to try and time my run, which gives me the best opportunity to get the best asset that I can. So I might make a judgment call to sort of say, well, if we're close to an interest rate pause, and I believe that demand is going to be released, there'll be a bit of and I don't want to be competing against those, and I'm happy to take a calculated risk of a correction of 1 to 3%. So that buys me the next 3 or so months before I can execute. So first I've got to find the property and get in, because the moment that pause happens, we are anticipating that there will be some pent up demand. We know it in our own business in terms of people are looking for some confidence, and we're telling those people who are looking for confidence, you're crazy. You need to start thinking about what you're doing now, because you want to get in before the vast majority of people get in. And that gets worse when interest rates start to go down. Now, the analysis out of the US says that it's about 6 months between the finishing of the tightening rate and then when rates start going down. In terms of that's that period. For us, we've got a little bit more of a difference in that, but it's very clear that once the RBA are confident that inflation's getting back to their target range of 2 to 3%, that rates will come back to a normalised level. We talked about that before, normalized level being around 2.5 to maybe 2.85%. That sort of range is what they're sort of saying is a more normalized setting. So that means interest rates are going down. That will spike sentiment. And when it spikes sentiment, there's going to be even more borrowers coming in and buyers coming into the market. So that's what the great investors understand this. They run their hypothesis and they look at that particular story, and then they execute with that informed knowledge. Of course, there's still risk. Please don't understand that this is not a guarantee, but based on our baseline thesis, in terms of what we think is going to happen around the cash rate, that's where we think the timing of the bottom is going to be sooner rather than later.
That's why real estate is more tricky, Ben, because of it's not a homogenized product. It's very difficult to get in. And it's not like saying, I see the market's timing, so I'm going to go buy 1,000 bank shares and I can get that executed today. You can't do that with real estate. And I guess that's the important thing that I'm trying to labor here for anyone who's listening. And we're going to, just for the record, at the end, we're going to talk about the people who should act and the people who shouldn't act.
Yes. The risk and the opportunities. Yeah, we'll round off with the risk.
This is not everyone should act, but I'm talking to the people who probably should act. It is not a homogenized product. There is lead time, and there is jockeying, and real estate's an inside job, Ben. Let's be honest. It's if you're on the outside, it's not easy to get in. So imagine if you're on the outside and the lead time and trying to get the right assets at a time when demand starts to release a little bit. That's going to make it hard for everyone. So that's what we're saying here.
Okay, so to round out the conversation before we start thinking and talking about some of the capitals where we're looking at and we're seeing interest on the ground, the next question comes back to the depth of the demand story, right? So it's very hard to work out, but we obviously have metrics that do that in terms of demand supply ratios and all of those types of things that we use. And then it comes the question of, is it going to be a V-shaped recovery or is it going to be a U-shaped recovery? And the logical suggestion says that this is going to be more like a U-shaped recovery than a V-shaped recovery. But in terms of what would instigate a V-shaped recovery is if interest rates were to come down sooner than anticipated. So let's say the RBA overcook it, and then they have to start adjusting the cash rate down. That's going to change sentiment quite dramatically. And that's the combination. So it's the combination of reduced interest rates and buyer sentiment turning into a positive sentiment that is going to be the catalyst for a stronger recovery. But we would expect to see that probably either at the earliest later this year or early 2024. But for now, it is about securing that asset, knowing that you're very close to the bottom, that you're playing the long game. This is not about speculating. You're holding this asset for the next 20, 30 years or beyond in terms of what that looks like. And so that's not a bad little segue to start also talking about markets within markets. So what we thought we would do is just share our thoughts on some of the broader markets around the country. We're not going to go into the 50 significant urban areas, but we are definitely going to say that, in terms of what we're seeing for now, because remember, this can change it sort of changes in quarters is the way we see these trends start happening. It's certainly not overnight. It's certainly not monthly. So for the first quarter to maybe first half of the year, this is what the data is telling us. This is what the field research is telling us in terms of markets that have opportunity, thinking of the mid-term and longer term and what's about to play out in terms of the cash rate changes.
And some of our feedback here is a reflection of affordability too, Ben, because you've got borrowing capacities that are being dramatically reduced by policy at the moment and interest rates. So some of these that we're going to talk about actually have the ability to satisfy that affordability criteria. The first one we'll chat about is my hometown of Perth. It's been quite resilient, Ben, and having spent some time over there, my sister, my family's got property over there. The anecdotal evidence is there is strong demand, particularly for rentals. That's not surprising across the country.
Yep.
But our team is actually facing loads of competition over there, even despite what we've experienced at the latter half of last year and started this year. So we see some potential in that market, particularly as that matures as a as a market over the next decade, rather than just being a mining, a derivative of mining. There's other parts of that market that are maturing, and the affordability when you compare to what the opportunities are across the country. Now, I'm going to premise this by saying too, Ben, that we don't want to contribute any further to the thing that we hate the most, which is generalized commentary helps no one, right? So we haven't been specific about where in Perth. We haven't been specific about which part you avoid, all that sort of stuff. So we're just we're blatantly saying here, do a bit more work. But as a general statement about these markets, there's some opportunity, but we do not like generalized commentary because that doesn't help anyone.
No, and what people mightn't understand because they're not right in knee deep in the data, but there's actually 3 markets across the capital cities in Australia that are actually growing in value, that reported growth in those particular markets. And those markets, there was a sub-quartile in Adelaide, there was a quartile in Perth, and there's a quartile in Darwin in terms of where they're actually not going backwards, they're actually growing in value. And so what Bryce is pointing out to is we've got competition in those particular spots, and that's contributing to obviously shortage of supply, high demand is moving the value in that particular area. But I think the message you had there, Bryce, around some of those affordability suburbs probably does give a bit of a clue in terms of when interest rates are a little bit higher. Some of those markets where the yields are really strong could attract a lot of those investors coming into to have a bit of a sniff around those particular areas as well. Looking at our next market now, it's actually close to my heart. It's my hometown, and that is Melbourne. So we went through a recession. We went through very strict lockdowns during the COVID crisis, and we didn't have that same economic bounce that say Southeast Queensland and Sydney and Adelaide and those other markets had. So our peak to trough or trough to peak period during COVID was around 18%. We've since given about 10% of that back. And so I do see with the immigration story for Melbourne, Melbourne being the most popular destination for most new arrivals because of our multicultural branding that we've got out there. So I do see Melbourne, and this is again a long-term play. I'd love everyone to have a good asset in Melbourne and Sydney because you've got that insurance policy of being a global city, of being a knowledge centre. So we do see pockets of Melbourne having excellent opportunities for some opportunity in the first 6 months of this year. And over to you for the next one, Bryce.
Well, Southeast Queensland, Ben. Now, I am aware that there is a lot of headlines right now saying that particularly Brisbane, is giving a fair bit back, and that's true in some cases. But I'm still thinking that they're in good shape for the reason that's always been important in Southeast Queensland and some of these pockets. Is because the price discrepancy between its nearest neighbour of Sydney, or major neighbour of Sydney, is so it's large. So so the lifestyle's still there. The fact that the culture is developing in those areas. People want to move and have a different pace of life and style of life. So whilst there have been some of those gains giving back, I'm still confident going forward that the demand will still exist in those areas, Ben, particularly in housing in Brisbane, and in some cases in sort of Gold Coast and Sunshine Coast that perform well. If you can afford it, still buy the land, still buy the houses, but I'm still comfortable going forward that those areas should look solid.
Well, interesting enough, Bryce, what's causing the bigger correction, if we actually have a look at the data, is it's the top 75% quartile. So the highest, most expensive 25% of properties is down 6.6% in the month. So that sort of gives you, so when you see a reading of, down 1.2 across the whole median of Brisbane, it's not a true reflection. Like you're seeing some of those lower areas only down 2% or something along those lines. So, but Brisbane is definitely doing the classic story of over exuberance. But if you can pick the eyes out of that, which you can at the moment still, there's enough in there. Similar to Adelaide's story. Adelaide has had a terrific run, and it's been the city that can, and it continues to keep canning, in terms of go. So we're getting to the end of that sort of property clock in that particular market. So you want to be really clever about picking the eyes out of Adelaide. It's not a dartboard story in that particular market, but there is definitely some opportunities there. And again, there are pockets of that market that are actually in growth territory in terms of that. Looking at our biggest property market of all, Sydney, what has been really interesting about the correction in Sydney is it's been quite broad. So it hasn't all just been the top end of the market. Yes, the top end of the market has come off, but the middle section of the market has also given up some of that growth. So the question then is, you would think that as the market turns, there's going to be some okay opportunities in that particular market as well. So where I'm going with this is that once we start seeing more of that demand indicator showing up and our DSR scores and our location scores start to tick up in the right directions, we'll be able to be more precise about that at the moment. Like in the middle of COVID, every market was reading really positive. Now we've got every market, so we've got to pick the eyes out of those particular things. But that sort of rounds that. Canberra's, well, we don't touch Canberra because of the land tax and the way in which they operate there. Queanbeyan, you want to be sort of, again, you want to watch that market for a little bit. And Darwin is one of those sleeper markets. The biggest problem for us is the long-term economic story of Darwin in terms of how that plays out. We tend to play around, if you know us, we tend to play around the big cities and the commutables to those big employment centres. And we play in sort of the top 5 capitals. So there's really no reason for us to make further comments around those types of things. But that just gives you a good idea in terms of what we're thinking about those particular markets.
So it leads us to, Ben, where are the risks and the opportunities? So who should actually be busy at this time and who should actually be sitting on the sidelines and not doing anything? And I guess those who should buy, this will not be a surprise to anyone, but those people who have a dedicated plan in place that they have cash flow modeled and have buffers in place should be considering now is a really good time to be buying, because underlying our overall thesis on this podcast is we are time in the market. So we are long-term property investors. And so if what we talk about today is true, that you can get in, whilst you're not putting yourself in peak pent-up demand, now's a pretty good time to be buying A assets rather than compromising on B's and C's later. Secondly, someone who should be buying now, Ben, is someone who actually does have the borrowing capacity, because it is more challenging than ever, and we acknowledge that. Yeah. But if you are one of the folks who do have that borrowing capacity, and you have the previous one where you have a plan in place, you've got a roadmap to where you want to go, and you've got a buffer in place, it's good. And then I guess, Ben, this is a philosophy more than anything, but just someone who sees an opportunity, someone who's an optimist, who's got a long-term outlook, sees this as an opportunity. I spoke with a mate on Sunday night, Ben. He's been looking forward to this for a long time, been getting in cash positions, ready to go. So it's someone who has seen a lot of cycles. So it's those people that should be buying. But what about you, Ben? Who do you think?
That's the courage and confidence of your conviction, right? So similar to what we've been talking about here today, we've got a strong conviction based on the data that we're seeing. Now, if new data presents itself, our conviction can change. That is the rules of investing. A strong conviction, strongly held, a conviction strongly held until further information is made present for us. And so that's the view we have. So if you've got that strong conviction and you're in that financial opportunity to do so, then you're going to act. And we said that last year, Bryce. The people that we were seeing acting last year were the ones who had been here before. They were the repeat buyers more so than the new ones coming in. But if you're thinking about, where the bottom's at, our conviction is that it's not far away from flattening out. And so, we won't see the bottom at the end of this year. We believe we'll see the bottom sort of more towards the middle of this year. In terms of established property buyers, so again, they've been through this. It's not their first rodeo. We talked about that. Upgraders, if the right property presents itself and you've got cash, don't kick yourself later on. Like, don't think, but wait a minute, we'll get a bargain later on. But you are going to drive past that property and you're going to tell each other, you're going to fight about it. It was you. It was not like, just buy it, right? Like, go after it if you can, because you'll be forever thanking yourself for that firm decision. Again, that strong conviction. Borderless investors makes a lot of sense to me. It is one of these times, and I feel like I'm apologizing for it, but the reality is it is absolutely one of these times where the people who have the financial well-to-do to actually act, they're going to continue to build their wealth greater and stronger than those who don't, because it really is, a classic time where be greedy when others are fearful. I know that I don't like that saying. It's similar to, when people use WealthSPEED and Wealth Clock and they're thinking about it's a game and I've got to get the most wealth. No. Wealth Clock and WealthSPEED are all about teaching you to be opportunity aware or problem aware. They're not about bragging rights. So ultimately, from that point of view, this is a time for you that if you are in that potential position. Who shouldn't, Bryce?
Who shouldn't buy? I call them fair weather, but it's kind of uneducated investors, people that are not convicted in the baseline thesis of long-term investing. Buy the best asset when your cash flow allows, correctly finance and hold it for the long term. People who are susceptible to blaming circumstances. You shouldn't be here. There will be some negative mainstream media coming. So the other one there is those that are informed by mainstream media shouldn't be investing right now. Shouldn't be entering the market, that is. Yep. Those who, this is serious. If you are cash flow or borrowing capacity challenged and there is serious heat in your household, you should be getting that sorted first. That is a number one priority, and adding extra leverage and extra pressure on that. For some households, they're under enormous amounts of strain, not only financially, but emotionally and relationship-wise. And so that stuff is critical and important. So if you find yourself in that particular scenario, you should be sitting out and you should be getting your house in order and making sure that becomes your priority. Super important. Those people who are not taking expert advice. Ben, you and I have been analysing this for 20 plus years. We've been preparing for this podcast for a number of days. We've been analysing the data. It has taken us a fair bit of time to not only map the technical with our own experience and what we're seeing on the ground. So if you're not taking advice from experts on when to be in, how to structure it and what to buy, that's going to be super challenge. What else, Ben?
Yeah, if I can also just, put some icing on that story there, Bryce, around those challenged, borrowers. This is not a time for speculators, right? So if you're thinking that you can make a quick buck out of property to solve your other financial problems, please don't. Yes. This is not your space. This is not your time. As Bryce says, get the house in order, build it on solid foundations, and move through that. From my point of view, the other noise that you're going to be hearing, not only through mainstream media, but just, the lack of confidence because of the general sentiment and the general conditions. Again, it's those who have strong convictions, strongly held based on, the research that they've done and the data they've collected to be able to do that is also going to be, really, really important for them. There is going to be, until we see a turn in the market, a limited amount of supply. So again, don't just jump at anything unless you've done your due diligence. So you mentioned fair weather investor. That's the uneducated buyer for me. And the other risk that I see, Bryce, is there is going to be talk of this financial cliff that households are going to fall off, and that's going to lead to the scaremongering around mortgage in possession and defaults and the like. So I think we need to also address that risk.
Yeah, I agree.
The risk really does, from a data point of view, what you're looking for is systemic risk. So you're looking for clusters of those areas where it's really going to impact the buying opportunities and the borrowers in those areas. Now, that would traditionally be, and again, I don't want to generalize too much here, but if you're a new borrower, a new first home buyer in the last few years, and you've also, started a family and you've got a big mortgage, you are the ones that are going to be under the most stress. So you can be, and they can be spread out right across the country, but it is usually those new estate areas where it shows up in the data that there could be mortgage stress in those particular areas because these people are trying to live out the great Australian dream. They expected interest rates to be lower for longer. They've enjoyed strong surpluses and savings, and now they've all been evaporated, and they're going to have to readjust, their living standards. The good news for those people is there's still plenty of, secondary jobs and part-time jobs going around to potentially, try and meet the requirements. It does mean that the family unit might have to work day shifts, night shifts, and do a bit of extra work. So that's one thing that's going to save a record number of defaults. And the other thing too is really about what the banks have done and what evidence that they bring to the table in terms of their behaviour since the last big time that we had, sort of a really deep recession back in the 1990s. The banks were ruthless on mortgage in possession sales, but we saw through COVID that the banks want to work with you. They want to set up a repayment program. They want to potentially look at ways to do repayment pauses rather than a situation where they are completely wiping you out, because a mortgage in possession sale will effectively get the bank their money back. They don't care anything past that point traditionally. And so you've then got to go and rent somewhere, which is probably going to be, as much, if not more, around the repayments. So it's just a difficult situation. So we know through, their behaviour and their maturity in terms of their connection with community is that they're unlikely to be ruthless around those mortgage in possession. So I summarise that by saying, where are those clusters? Where are those new estates where that type of household is showing up? And there's potentially going to be pockets of risk there, but I don't see it systemic right across the country. And if it starts to look like that, I don't suspect that the RBA will have any other decision but to start to wind down interest rates, because that in itself, with property being too big to fail and the banks being too big to fail, will cause more significant pain than any wage price spiral or short-term inflation challenge that we've currently got.
So there you have it, folks. We've covered a lot here in our property market outlook for 23. So I guess in summary, here's the cliff notes. We think that inflation has peaked. We think that the interest rate pause is near. We see that the bottom of the property market is also near, which creates an opportunity. So just a few reminders that we've had. We are not one market. Generalized commentary does not help anyone. Get localized research on specific property, because you only really want to know. You get headlines report at a global level, but you only need to know the performance at a local level. So make sure that you focus on that. You need to have a plan in place, and you've got to stay long-term focused. If that's you, I think there's opportunity for you in 2023. But as we talked about at the end there are some people that should certainly sit tight. Yeah. And we certainly encourage you to do that if that's you, if you can relate to anything we said. Your employment's at risk. There's just stress under your household. That now's not the time for you. So, mate, we've covered a lot. And hopefully the idea was to say, well, we talked about this at the top. Here's what we think, right? Here's the data that we've used to arrive at that. Now it's for our listeners and our community to go and digest that and see if they resonate with that. And if they do, see if there's opportunity for them to act. If they don't resonate with us, well, clearly then that's a signal that to go and get some information elsewhere to form their view. But clearly I wouldn't suggest they act if they don't resonate with us, because they might have a contrarian view to ours. That's what's going to happen in 23. Time
will be our judge in terms of whether we perfectly timed it, whether we're a month or two out. But I think I'm convicted to the statements that we've made, and that's been us for our community, our honesty and our authenticity around. We call it as we see it. We'll continue to keep doing that. If you look at our past history, all of those episodes are there. So if you want to compare us when winter is coming and when the market's booming, and when we said it was going to
COVID,
we said this time last year about rents are going to go through the roof, but the market's going to really pull back. All of that commentary is out there for you in terms of that. But we've also got markets wrong before. We talked about where we got up in Brisbane a bit too early and when we didn't get into Hobart at the right time. So we are also human. Any of this sort of forecasting game is very difficult. There's a famous line in forecasting: you're either lucky or you're wrong. So that's the story too. But we are looking at the data, and we're putting a hypothesis and a thesis together around what the data is showing us. And we are ahead of the curve. Make no mistake, the stuff you're seeing in the papers and what's being written about in mainstream media, they will start to be reporting on the inflation spike is behind us. They'll start be reporting in the next couple of months about the trends in terms of consumer spending and unemployment starting to go up. So we are very much in front of that curve, but we're anticipating that there is educated consumers out there now, and that's what we saw in the equity markets. Equity markets were meant to be dull and boring and potentially, going sideways or backwards for the first 6 months of this year based on the economic outlook. Well, we've seen what's happened in the equity markets in the last 2 to 3 weeks. Incredible rebound because they're forward looking. They're not just looking at what's happened. They've already seen that inflation has spiked, and they're now looking at, results in 2024 and 2025. And as investors, we probably need to take that type of mindset in terms of how we're looking at the property market. Because again, we don't want to be speculating. We want to be buying for the medium to longer term. And that's going to be part of that. And today's episode has been very focused on capital growth story, because everyone knows that with record level immigration and vacancy rates at sillily low levels, rents are going to continue to go up to that margin, and they are going to continue to increase. We'll start to see yields in the 4% consistently right across the country.
Which makes the relative returns attractive, which then means that it's putting extra pressure on an essential need, which is shelter over our roof. So, but I think to summarise what you just said, just check our track record and see how we've gone. But the idea here, folks, was to inform and hopefully give you some guidance around what we think will happen for the remainder of the year. So we're still positive and buoyant and excited and optimistic about what 2023 holds. Hey Ben, my life hack today. I've been dying to use this one for a little while because it happened before Christmas, but I haven't had the opportunity. But I think I've said this before, and if you're new to our community, I don't let anyone get in contact with me on my phone with one exception. That's via text message. I get a notification when there's a text message. Otherwise, there's no notifications. I turn them all off. All social media, everything. You just can't get me. So you can imagine my excitement when Apple released finally that you can actually read a text message and then slide it across and mark it as unread. And as basic as that sounds, it's been a game changer because when you're going along, you read the text message, I'll get that later. Just the sheer act of being able to mark it as unread has been a nice little life hack for me. So I don't know if you knew that, Ben.
No, I didn't, mate. I honestly had no clue, but that's good because I do like to, when I want to get back to something, that's how I do my to-do list. I mark it as unread. So now text message is not your strength, Ben, because I've known you for many years, and you don't get back in a hurry. Let's be honest. No, so
and
I can't type or spell, all that stuff. It's true.
But for those folks who are like me, who loves the idea of managing your text messages by marking it as unread, get into it later. Go and check it out. If you've got the latest update, you can slide it across. There's an option for you to mark it unread. And there you go. So wait until I tell you next week's life hack regarding text message, Ben. I'm super excited. You're building momentum. All right. So there's a series.
Well,
it's a series of 2, right? So unless I can come up with the one for the 3rd week. But there you go, mate. What's making property news?
Well, mate, we all know that China's gone off their zero COVID policy, right? And they're opening back up to the world. And there's obviously been a lot of people that have been ready who have dual citizenship between China and Australia, and there's I read with interest of a particular buyer that was getting on a plane and coming across last Saturday into the Melbourne market.
How much do you have there?
He wanted to buy a house price.
Oh, good. How much do you have?
He had 100 million. So he had a lazy $100 million, and so I love the strategy of the agent, Miss Zhu, Mandy Zhu. She's very clever. She's like acting like a buyer's agent. She's I've got my $100 million buyer. Yeah. Anyone got a house that's worth $100 million? I mean, I could sell me $50 million house for 70 to But no, so of course I don't have a $750 million house.
No, you wouldn't live that low, would you?
God, no. Yeah, right. So anyway, I thought we would end on a bit of a fun note. I know that's that is living outside of our means, but to imagine if you could actually fly into a property market, Bryce, and you've got $100 million to spend.
Yeah.
That would be a record in the
Talk about
Melbourne
scarcity.
market, I think, or thereabout. So I think you could buy maybe 1 or 2 houses. So the door knock would be pretty quick. I've got a buyer here.
Well, it kind of reinforces our point today, Ben. Just because you've got money to spend doesn't mean you can go in the market and find it straight away, because there's a lag and a lead time to actually get it done. So
very true, very true.
very good.
There you go. So that's and there's been some interesting sales. $40 million recorded sale. Of note in the last 12. There's been a lot of 80 million. So it's at that top end, that Uber top end. Don't know where they get their money from. But
bank
whatever
stocks,
they
mate.
do,
They got bank stocks.
they put it into real estate. That's for sure.
Good to hear.
So that's
there
what's
you go,
making
folks.
property news, mate. There you go, a little fun one.
Thank you, mate. Given the show has been what's making property news, nice of you to leave us a nice light one there, which is good. And you made good on last week's what's making property news. Do you remember?
Which I used the story of the what's making property news was WealthSPEED and WealthClock, wasn't it?
Yeah, well, you said, next week's whole episode is going to be what's making property news. So
good point.
You did make good. So there you go. There you go, folks. Hopefully that's been helpful. Let us know on socials. Give us some feedback. Send us an email. Let us know what questions you might have that you want answered that Ben and I can cover in an upcoming episode around this sort of stuff, because we'd love to address the questions that you're facing in the field right now with household portfolios, property purchases, whatever it is, Ben. And just a reminder, if anyone wants to go into the description on our podcast, Ben, you have all the links. Now, the main one we want you to do is go and download the More app for free and get sorted. Make sure your house is in order there. But mate, until next week.
Knowledge is empowering, Bryce, but only if you act on it, because your future self will thank you for it.
Cool, mate. Pull it out again. See you next week, folks.
Hey guys, Bryce here again. Just want to catch you before you go and let you know, if you're new to our community, there are a lot of episodes to catch up on, but it's really important that you start from the very beginning at episode number 1, because episode 1 through to 20 share all of the foundational pillars and frameworks that you need to know to get the best out of listening to this podcast. So I'd recommend that you start there, and the little tip is to maybe start on 1.5 speed. Now, for those of you that are time poor and don't have time to go back from the beginning, don't worry, we've got you covered as well, because we've created a binge guide that goes through all of the details and makes it easy for you to read and get up to speed very, very quickly. So if you go to thepropertycouch.com.au/fast track, you will be able to download that binge guide and you will be up to speed in no time. And whilst you're there, I've got a few extra goodies for you, because we have our top 5 frameworks that you'll learn on this podcast, as well as the Make Money Simple Again ebook, which will help you with the foundations of basic money management, so you'll have everything you need to succeed in building your own lifestyle design and getting the best out of this podcast. Now, just a reminder that anything that we cover on this podcast is not considered financial advice. We certainly recommend that you get your unique circumstances looked at by your individual advisor, and everything we talk about is just general in nature. But folks, I want to encourage you again to go to thepropertycouch.com.au/fast track, and you can go and get all those goodies and catch up right away.